shall now discuss final accounts of banking companies. For this purpose, we will be touching upon the following items. One is, what is the meaning of banking companies? What are the definition of a bank? What are the functions of a bank? What are the requirements of banking companies in terms of accounts and audit? What are the significant features of accounting system of banks? What are the principal books of accounts maintained by banks? How to prepare and present the financial statements of bank? How the asset classification is done? How income recognition is done? And then what are the provisioning requirements? And how are the investments classified? These will be the areas which will be considered in this topic. So, as we know, a bank is defined as under a banking company means it includes any company which carries on the business or which transacts the business of banking in India. That means any company which is carrying on the business of banking is called a bank. And normally a banking company is governed by the provisions of the Companies Act 1956 and specifically by the Banking Regulation Act 1949. So, these are the two principal regulations which govern the banking companies in India. If it is registered as a company, then Companies Act also will apply, and since it is a bank, the Banking Regulation Act will apply. But in the case of those banks which are not registered as companies, for example, State Bank of India, which is come into existence by an act of parliament, in such cases, such banks are governed by the particular act of parliament, that is in case of State Bank of India, the State Bank of India Act, and also by the Banking Regulation Act. So, now let us understand in detail what is the definition of a bank and what are the functions of a bank. So, banking has been defined under section 5 of the Banking Regulation Act. It means accepting of deposits of money from the public for the purpose of lending or investment, and the deposits repayable on demand or otherwise by check, draft or otherwise. That means here there are three important things we have to. One is banks are accepting deposits of money from the public. And what is the purpose? The purpose of this is to lend money or to invest this money. And the deposits which they are taking is either repayable on demand or otherwise. That means they may be repayable after a particular period, and these are withdrawable by check, draft, order or otherwise. That means all these monies can be withdrawn by means of a check, draft or order. So, only banks are permitted to issue checkbooks. That means all those finance companies which are otherwise accepting deposits, but which cannot be, which are not allowed to issue checkbooks, are not treated as banks. They are therefore called non-banking finance companies. In addition to this definition, a bank is permitted to engage in certain classes of business which are incidental to the business of banking. That means whatever is necessary for the business of banking are also required to be undertaken by these companies. But certain things are prohibited in the case of banking. For example, banks are prohibited from buying, selling or dealing in goods except in connection with the realization of security held by it or in connection with the business of collection or negotiating bills of exchange. For example, they cannot indulge in buying and selling of real estate. But if they have come into the real asset in the course of their lending business, then such security can be sold by the banks. That is the meaning of banks being prohibited from buying and selling certain goods. Now, we will find out what are the requirements, what are the functions of banks, and then we will come to the requirements of banks. So, one, as regards the functions of a bank, as we know, the principal function of course is the accepting money on deposits and providing facilities to depositors for payment by checks. This is the important function of a bank. Then granting loans and advances, whatever deposits they have collected, they are lent as loans and advances. Dealing securities in securities on its own account or on behalf of customers. Then opening letters of credit, issuing guarantees, dealing in foreign exchange for customers or on its own behalf, transferring money from one place to another, that is called remittance, through demand draft, telegraphic transfer, bills, etc. Then acting as trustees and executors, and finally acting as merchant bankers. All these are the functions of a bank. And there are certain requirements in terms of the Banking Regulation Act as to how the banks are required to maintain their books of account and what is the rules regarding audit of the books of accounts of the bank. So, one is preparation of financial statements and accounting data. This is necessary. Periodically, banks are required to prepare their financial statements. A banking company is required to prepare and submit its account in the specified format given by the Banking Regulation Act. That means, the format of a financial statement to be submitted by bank is defined in the Banking Regulation Act, and accounts of banking companies are required to be closed on 31st March every year. That is common for other entities also. Audit is compulsory. That means, all the financial statements of the banks are required to be audited by external auditors once every year, and they have to be audited by a qualified auditor. What is a qualified auditor is defined in the Companies Act. In the case of audit, they are normally done by a qualified chartered accountant, and then these accounts are required to be submitted, and the accounts are also required to be published, and accounts have to be published in a newspaper circulating in a place where the bank has its principal office within 6 months from the close of the year. That means, banks are required to publish the financial statement within a period of 6 months from the 31st March of that year. That means, by the end of September, banks are required to publish their balance sheets in a newspaper which has got highest circulation in a place where the bank has its principal office, that is the head office. So, now let us try to understand what are the significant features of accounting system of banks. Particularly, this differs from the normal accounting done by the companies for the transactions. So, here the need for ledger accounts, especially those of customers being accurate and up to date, is much stronger than in most other types of enterprises. For example, in the case of a company, the ledger posting is done maybe once in a week or once in a fortnight or even once in a month, depending on the volume of transactions. But in the case of banks, there is a need to keep the ledger accounts of customers up to date at all points of time, as otherwise there will be lot of problems for the customers as well as for the bank. Therefore, ledger transactions need to be updated as soon as they take place. That means, instantaneously they need to be updated. So, therefore, banks play lot of emphasis on books of prime entry such as cash books or journals. That means, these books are not that important compared to ledgers, but in the case of other entities like companies, the prime books are more important than the ledgers. Here, banks are required to keep the ledgers up to date first, and thereafter they will have to update their prime books such as cash book and the journals. So, normally banks follow the procedure of voucher posting, under which the vouchers are straight away posted to individual accounts in the subsidiary ledgers. Normally, in the case of a company, vouchers are prepared, then they are journalized first, and then the journal entries are transferred to the ledgers. But in the case of banks, the vouchers are prepared and then straight away posted into the ledger accounts, because the idea is to keep the ledger accounts up to date at all points of time, and thereafter they go into the journal, they go into the cash book. So, the first, in the case of banks, they post the vouchers directly into the ledgers instead of journalizing the entries. Thereafter, at the end of each day, the debit and credit vouchers relating to a particular type of transaction, for example, if they relate to savings bank or current deposits or demand loans or cash credits, etc., are entered on separate voucher summary sheets. That means, they are all summarized, and then the total thereof is posted to the respective control account in the general ledger. So, general ledger contains separate control accounts in respect of each of these accounts, and these totals are taken directly to those control accounts. The general ledger trial balance is prepared every day. That means, the trial balance has to be tallied every day after taking out the balances in each of the accounts in the general ledger. So, we will consider some of the significant features of the accounting system of banks. One is the types of transactions. So there are two types of transactions. One is called cash transactions, the other is called non-cash transactions. Normally they are referred to as transfer transactions in the case of banks. Therefore, we have both cash transactions as well as transfer transactions, and we have got vouchers in the case of banks. All operations, both credit and debit, are made by means of a voucher. For that means for every entry passed, either a debit or credit, there must be a voucher. This is one of the important characteristics of branch accounting or bank accounting. Voucher may be either a debit voucher or a credit voucher, or in some cases it could be a composite voucher containing both debit and credit simultaneously. So examples of debit vouchers are checks issued by customers. Check itself is treated as a debit voucher. Withdrawal forms in case of savings bank account customers, or drafts issued by other branches payable at the branch. That means if the draft is paid on the strength of the draft issued by another branch, the draft itself becomes a debit voucher for the bank, for the branch which is paying the draft, and the dividend interest warrants issued by banks, customers, etc. These are all examples of debit vouchers. Similarly, we will have credit vouchers which are to be prepared by the customer, or in some cases by the branch staff also. And the checking also has to be done in a particular manner. In the case of banks, all entries in the personal ledgers and summary sheets are checked by persons other than those who made the entries. That means there is a bifurcation of duty. This is with a view to ensure that there is no collusion among people, so that the frauds are kept to the minimum. Therefore, the person who is making entries in the ledger is not the same person as the one who is checking the entries in these ledgers. And balancing, of course, also has to be done. A trial balance of all personal ledgers is prepared periodically and agreed with the general ledgers control account. That means, in addition to balancing the trial balance of the general ledger, each of the personal ledger accounts, for example, savings bank accounts or current deposit accounts, have to be balanced periodically. For example, in the case of savings bank, balancing is done every month. In the case of current account deposits, balancing is done every week. Therefore, this is known as balancing of books. Different periodicity has been laid down for different types of accounts, and these have to be balanced. Balancing means we have to jot down all the balances in the accounts of those ledgers. That means all balances in the savings bank accounts of different customers, and the total of that has to tally with the balance contained in the general ledger control account pertaining to savings bank accounts. And in terms of the Bankers Book Evidence Act, Banks Book Evidence Act, all the books of the bank include ledgers, day book, cash books, account books, and all the books used in the ordinary course of a bank. All these are treated as books as per the Banks Book Evidence Act. That means, in the case of dispute, these are required to be taken as evidence in a court of law. Now, let us try to understand what are the principal books of accounts in case of a bank. They are, one is the general ledger. This contains the control accounts of all personal ledgers, the profit and loss account, and different assets and liabilities account. That means there are three types of accounts contained in the general. One is all personal ledger accounts, that is, for example, savings bank account, or a current deposit account, or a demand loan account, or a cash credit account. Then we have the profit and loss accounts, that means interest account, commission account, or salaries account. These are accounts related to income and expenses of the branch, and then different liabilities in the assets account. For example, assets will be all the advances, or in addition to advances, we have assets such as fixed assets, miscellaneous assets. Liabilities, in addition to deposits, include other liabilities. And there are certain other transactions which are also required to be recorded. They represent the agency business handled by the bank, on which bank earns a fee-based income. For example, on the LCs opened by the bank, that is letters of credit opened by the bank, or bills received or sent for collection, or guarantees issued, bank earns a commission. And so these are also maintained separately. That means there will be a separate register for LCs opened, or guarantees issued, or for bills received and sent for collection, etc. And in addition to that, we have got a profit and loss ledger. Some banks maintain a profit and loss account in the general ledger and maintain separate books for each revenue or expense. That means only profit and loss is maintained in the general ledger, and under each head of income and expenses, separate books are maintained. And in some other cases, some banks maintain all different heads of income and expenses in the general ledger itself. So both are common in the case of banks. Then regarding the subsidiary books, we have personal ledgers for each type of business done by the bank. So each control account in the general ledger is supported by a subsidiary ledger. For example, subsidiary ledgers are maintained for all types of deposit accounts. For example, savings bank account, current deposits account, recurring deposit account, etc., which contain accounts of individual customers, various types of loans and related accounts such as cash credit, term loans, demand loans, bills discounted, letters of credit, guarantees issued, etc., where the liability of each customer is reflected. So these are called the personal ledgers. They reflect the balances of the accounts of each of the customers. And then in addition to that, we have bills registers. In case of different types of bills purchased and sent for collection, they will have different kinds of registers. For example, bills purchased register, then you have inward bills for collection register, then outward bills for collection register, etc. In the case of bills purchased and discounted, party-wide details also have to be kept, because banks may be purchasing bills from several customers, and therefore we need to know the liability on account of each of the customers. Therefore, there is a separate liability register maintained in respect of bills purchased discounted by from a particular customer. And entries in all these registers are made by reference to the original documents. A voucher for the total amount of the transactions of each day is prepared in respect of each register, and the voucher is entered in the day books. So therefore, there will be one voucher for all the bills entered in the bill purchase register or bill sent for collection register, and one entry is passed, and this will be reflected in the general ledger control accounts. In addition to that, banks are also required to maintain a number of other books such as drafts issued register for the issue of drafts, drafts paid register for drafts paid by the bank but issued by some other branches, and registers for issue and payment of mail transfers or telegraphic transfers, bankers checks, travelers checks, gift checks, letters of credit, guarantees, etc. Separate registers are maintained, and we have a suspense ledger in order to take care of those entries relating to the suspense account, and a charges register for expenses. So all kinds of charges incurred by the branch are entered in the charges register, and there again they are classified into different heads such as salaries, then stationery, then postage, etc. And then coming to the presentation and preparation of the financial statements, how it is done also has been laid down. So we will have to discuss as to what is the format of the balance sheet, what comments are required to be given on the balance sheet items, and what is the schedule 2 in terms of reserve and surplus, and what is to be disclosed, and what are the statutory reserves which are to be disclosed. For example, statutory reserves have to be capital reserves, share premium account, then revenue and other reserves, and balance of profit. These have to be shown separately. The format of balance sheet, of course, is given in terms of the Banking Regulation Act, so that has to be followed, and then certain items have to be commented upon, and that is how the balance sheet has to be prepared. And in the case of different schedules, we will consider in short as to how the different schedules contain details of different kinds of entries. For example, Schedule C relates to deposits. This will contain demand deposits, which include savings bank deposits and also term deposits. They have to be shown separately. So both demand deposits and term deposits are shown separately. In the case of Schedule 4, they relate to borrowings. So borrowings are again classified into borrowings from Reserve Bank of India, borrowings from other banks, borrowings from other institutions, agencies also have to be shown separately. In the case of Schedule 5, we have to detail the other liabilities and provisions. These relate to bills payable, inter-office adjustments net, then interest accrued, and others have to be shown separately. and Schedule 8 is in respect of investment. These are the investments made by the bank either in the stock market or in the government debt market. Investments in India and outside India have to be shown separately. That means banks, if they have made investment outside India, that has to be shown separately. And in respect of investments, further breakup is also necessary as to investment in government securities, other approved securities, shares, debentures and bonds, investment in subsidiaries and joint ventures of the bank also have to be given separately. And Schedule 9 is in respect of advances, that is loans given by the bank. 3 different types of classifications have to be given. That means all advances have to be classified into 3 different types. First type is in terms of bills discounted and purchased, overdrafts, loans and term loans. They have to be classified into these categories. Second type of classification is in terms of securities, that is into those secured by tangible assets, those covered by bank and government guarantees, and those which are unsecured. And third type of classification is in terms of advances in India and advances outside India. In case of advances in India, again they have to be classified into priority sector advances, public sector advances and advances to banks and others. This is how advances have to be classified in terms of the Banking Regulation Act. Then Schedule 10 is meant for fixed assets, where the premises have to be shown separately and other fixed assets have to be shown separately. And in the case of Schedule 11, which pertains to other assets, these include inter-office adjustment net has to be shown if it is a debit balance, then interest accrued, tax paid in advance, deducted at source, stationery and stamps on hand, non-banking assets and others have to be shown separately. And Schedule 12 is meant for contingent liabilities, which also have to be shown. Then we will go to the format of the profit and loss account. This format has been given in the Banking Regulation Act. As per that, banks are required to prepare their profit and loss account. Certain disclosure requirements are also there. All these disclosures which have to be made are required to be made along with the profit and loss statement. There, the requirements are in terms of non-performing assets, what are the gross NPAs, what are the net NPAs, how the movement of provisions held towards NPA has happened, that means whether provisions have gone up, provisions have gone down. Then movement of provisions held towards depreciation on investments, that in respect of investments also provisions are being made and how these provisions have changed from last year to the current year. Then asset classification also has to be shown separately. Income recognition and provisioning norms also have to be disclosed as to how income has been recognized in the books of the bank in terms of non-performing assets and performing assets. Then we come to asset classification. This is another important thing which banks are required to disclose in their balance sheets. As we know, banks' advances are classified into performing assets and non-performing assets. An advance giving income on continuous basis is called a performing asset. That means it gives income to the bank. But if it stops giving income, then it is treated as a non-performing asset. Normally, an NPA is defined as one which remains out of order for 90 days. This is in case of a cash credit or a overdraft account. But in case of a term loan account, it is treated as an NPA if the interest installment remains overdue for more than 180 days, while a cash credit is treated as NPA if the outstanding amount remains over and above the sanctioned limit drawing power for more than 90 days. Bills purchased discounted are treated as NPA if the bill remains overdue and unpaid for 90 days. In other cases, the amount outstanding is less than the drawing power, it is treated as NPA if there is no credit or in the account, or if the credits are less than the debit to the account on account of interest during the 90 days preceding the date of the balance sheet. This is how accounts have to be classified in terms of NPAs and performing assets. Then income recognition, as we know, banks have made a departure in terms of income recognition. Normally, most of the entities follow the accrual concept, but in the case of bank, accrual concept is followed only in case of performing assets. So, income from performing assets is recognized on accrual basis, whereas income from NPA is recognized purely on cash basis. That means only when the income is actually realized, that is cash is received by the bank, then it is treated as income. So, this also has to be disclosed in the financial statements. Then in respect of provisioning, banks are required to make provisions in respect of not only non-performing assets, but also make general provisions on the standard assets also. So for this purpose, we classify the total assets into 4 categories. One is called the standard asset, where though the asset is standard, banks are required to make a provision to the extent of 0.4% of such assets. This is as a measure of abundant precaution that certain funds are earmarked and kept separately as provisions. In the case of a substandard asset, if an asset has remained in NPA for a period not exceeding 18 months, provisioning required is 10% of the total outstanding. In the case of a doubtful assets, provision required is 100% of the unsecured portion plus another 20, 30 or 50% of the secured portion, depending on when the asset has been in the doubtful category for up to 1 year, up to 3 years and more than 3 years. That means if it has been in the doubtful category for up to 1 year, then only 20% additional provision, and if it is up to 3 years, then another 30% additional provision, and if it is for more than 3 years, 50% of the secured portion as additional provision also has to be made. In the case of loss assets, of course, entire thing has to be provided for, that is 100% of the total outstanding have to be provided for in the case of a loss asset. And now let us discuss about the investment. Even the investments like advances are also have to be classified in a particular manner. In this case, government securities and other approved securities which are generally used for meeting statutory liquidity ratio are called SLR securities, and those securities which are not used for the purpose of SLR are called non-SLR securities. These securities are normally shares, debentures and bonds or investment in subsidiaries, joint ventures, etc. And both the types of securities, that is both SLR and non-SLR securities, are required to be classified into 3 categories. One is called the held for maturity, second is available for sale, third is called held for trading. Held for maturity, as the name suggests, these are investments which are held for maturity. That means they will be encashed only at the time of maturity of those investments. And normally the guideline is that investment under this category, that is held to maturity category, should not exceed 25% of the bank's total investments. In the case of securities held for trading, that means they can be sold even before they are maturing, and they have to be sold within a period of 90 days. That means if the bank earmarks certain securities as for held for trading, then they cannot hold those securities for more than 90 days. That means there should be a turnover of these securities within a period of 90 days. Except for held for maturity investment, others have to be marked to market. This is an important thing which you have to remember. That means mark to market means we have to take into account the market value of these securities. If the market value has gone down, then that difference has to be provided for in the books of the bank. And if the market value has not gone down, if it has not gone up, then that extra value should not be recognized. That means they have to be shown either at their actual value or market value, whichever is lower. Only in the case of held for maturity investments, there is no need for marking them to market. That means they will continue to be held at the carrying amount in which they have been taken into the balance sheet for the first time.